Good morning, Facebook. Actually, our Alliance Movement Facebook group. I hope everybody had a good weekend. This morning, we are with Olga Savelov, and
Good morning, everybody.
we're going to have our training, our mortgage training. And it's going to be about the reading the tax return, which is very important. I think you have different type of tax returns and different lines on that tax returns that are really important, right? So we will discuss that right now. All right, let's see. I think we're live. Let me see if I have agents on. Good. There you go. I see we're live. All right, Olga.
Good morning, everybody. One more time. And
Okay.
it's always a fun subject how to read the tax return. A lot of it is very complicated, but not that's hard. But so that I want to walk you through how to do it. In the first page, I have old tax return, which is 2015. I want to tell you what differentiates between 2015 and 2019 tax return. So
Let's go slow because I think we just put on the page. I want to make sure everybody sees it. I'm going to go and just scroll up. So this is a 2015.
So the only difference in the tax returns between 15 and 19 is lines where they show the income and also how much money you could do as far as deductions, right? So on the 15th, your income starts with line 7. That's W-2 income, and the business income starts at line 12. So let's scroll to the 2019 income, which is on the page 3. Okay, so here you will have the income start on a line 1, which says wage and salary, tips, and etc. So that income will come from W-2 income. It's combined multiple people's and multiple W-2s together, and it's one line, one income. If a person makes other income, it will all add up on a line 7A.
7A. Other income from Schedule A.
Right? 9. And then also, if a client gets IRA distribution, it will be on a 4A. If you have dividends, it's going to be on a 3A. And if you have any capital gain, whether it's from business, real estate, it will be on a line 6. 7A will be other income schedule C1 or schedule or line 9. So that's what differentiates your 2019 versus 15. Now, my comments under reading the tax return, we did it for 2015, so I want to show you where the difference is. Standard deduction.
On 2050, you need to go back to 2000?
No, stay in 19.
Okay.
So a standard deduction is changed from 15 to 19. Now, standard deduction for one person is 12,000, and for 2 people is 24,000. So it's going to give you a standard deduction here as well.
Number 9, she has a standard deduction of 12,200. Yeah.
Correct. So then you're going to see total income, and then after standard deduction, how much is taxable income. So let's go to the page 2. So here, if your standard deduction is higher than, if your deductions higher than whatever standard, you could recap it. And if it's not, then if it's not higher than 12,200 or 24,000, then you're gonna put it down more. So here it shows that on this particular tax return, the person will get a refund of $1,069.
So this person, hold on. So this is, let's go back to the 2015. So the deduction would be on page.
No, we're gonna stay on 19 right now.
Okay.
Let's go back to the
2015. Okay.
And the page 4. Look at the page 4, line 21A.
Yes, thank you. Guys, this is, so we're not able to actually work Olga's computer, and she's on the phone.
Yes.
And I have the documents and I'm following really badly her
No,
direction.
no, you're doing great. You're doing great.
All right, let's do it.
Okay, so let's go to the next page. And the next page, it just gives you an explanation as far as what 1040 tax return means. Again, don't worry about the lines because lines were typed in for 2015, but you could get the information where the W-2's income is, where's all other income is. So this way I recapped it, but forget about matching the lines. It will be off, but the idea will be the same because the description will be the same. Okay, so let's go to the page itemized deduction. We again, if you match 2015 with 19, it's going to be a little bit off, but amount will be the same and the recap will be the same.
So where would you like me to go?
So go to page 8. They could read those pages on their own, but let's go to page 8.
So Guy will share these documents with you on the
Right.
Facebook Alliance private group, Alliance Movement private group, and on our workplace page as well. All right.
Awesome. On the page 8, in the past, we were able to take out employee business expenses. However, because they increase how much is maximum deduction is to 24,000. I mean, not maximum, but how much is deduction for utilized deduction for 24,000. Most of the time, employee business expenses does not exist $12,000 or $24,000. So this page became not that many people could already take advantage of it.
Only, okay. And this is for
we're on the page 8.
Yeah.
Right. So then you're going to go to page 9 and it explains to you what's employee benefit expenses that was not reimbursed by employee. And then you're going to go down to
page 10, that was interest.
11.
Okay. Let's go slow because I want to make sure everybody understands what we're doing. So here we have vehicle expenses.
Okay. On page 11 is basically continuation of non-reimbursement employee expense. And it will allow your vehicle expenses to be deducted. But in current tax laws, it's not that much could be deducted. So we're going to skip that page. And we're going to go to page 12.
Okay. Profit and loss.
Profit and loss for business. If an employee have a profit and loss, if you get paid by owning your own business as well. So the thing here is we're going to right away ask you for a couple more things. So you're going to have a profit and loss for 1 year. We're going to average the income in the last 2 years. And we're also going to ask you to prepare a profit and loss statement for current year. Now, what is a profit and loss? Profit and loss is basically how much income your gross income received, what is your cost of goods, and what is all your expenses are. So this is for the whole year of 2015. It's very similar to current profit and loss for this 2019. So it's not really any difference. And it shows you over here the grocery. The person was working as tech and in securities, computer repair services. He worked. That person made $82,000 from computer repair. He hardly had any gross cost of goods, but he had all expenses. So 82,000 subtract cost of goods. Well, he did have cost of goods sold for 28,000, and he had other expenses.
All right, so let's go over those lines. I just want to make sure everybody sees this. So he had on line part 1 income, the gross receipt.
Gross receipt.
That's 2,000.
82,000. Then you have on line 3. Line 3 will be subtract cost of goods, which is line 4, sorry. Line 4 will be subtract cost of goods.
Which had 28,000.
Correct. And then you have a gross profit, 54,000.
Okay.
Then he has other income 3,500. So his gross income 57,500. And then you recap all expenses. That will total to 20,300.
Okay.
And then you have so you have tentative profit or loss 37,200. So for the banking income, we're not going to use 82,000. We're going to use 37,200. We're always going to use net profit or
So
net loss.
net profit was
37,200.
okay, because his gross profit was 54.
54 plus 3,500 other income. So his gross profit was 57,500.
Okay, and then where does he have that $20,000 of?
$20,000. If you take a look at line 9, which is a car expense, then you have $2,400
Slow here, yes.
description. I mean, it's recapped right here.
A recap of all his expenses. I'm just doing it. I'm just being the devil's advocate. It's like I don't know anything, so I'm asking. All right. So now we're deducting all those expenses of $20,000, and it comes down to 37,200, which we have on line 29. Right? Hello. Let me see if we still have Olga. If she's, can you hear me? Oh, we just lost her. Guys, I hope we can get her back. Let me try to text her. It's been the gods of technologies have not been on Olga's side this morning. Here you go. Let me add her to this. Hi, Olga.
Okay,
Can you hear me?
I'm back. Can you hear
We
me?
can hear you. Yes.
Okay, very good.
Yeah,
Sorry, I don't know what's happening, but okay. So then you have 37,200 net income. Now we're gonna go to pay. Oh, so if we're gonna use this income to qualify as self-employed income, we would need to compare 2 years as average. However, if 2019 income is lower than 2018, we do not average the income. We're going to take a lower income. We will also ask you if, let's say, for example, you do the mortgage right now in 2020, and we're already in December. We will ask your accountant to prepare profit and loss statement from January to end of November. We're going to see if your income is continue the same as the previous year. If not, we would need an explanation, and the income might be reduced for qualifying purposes.
Okay.
So now let's go to the next page. We're going to go to page 13.
Okay, let me just go to page 13.
Okay.
You have to bear with me. I'm not going to be able to see all your comments now as I'm working that PDF. Okay, page 13, cost of goods sold.
So so in the page 12, it was a summary. In the page 13, it describes how did they gain what is cost of goods recapped off. So here they give you a very detailed how did they arrive at cost of goods of $28,000. Now, some businesses do not have cost of goods. Some businesses just have for revenue and then expenses. Okay, so then we're gonna go to page 14 that explains to you exactly the income. How do we look at all expenses? So it's really very detailed explanation of every line. Same thing is going to go on the page 15. You could read that on your own expense, at your own leisure time. See, talking about profit and expenses.
Okay.
Okay, now we're going to go to page 16, which is depreciation and amortization. Again, not every business will have it, but again, I give you explanation on page 17. Capital gain and losses. That's going to be on page 18, Schedule D. So the capital gain and losses could be in a multiple different ways. It could be in selling your real estate, selling the business, selling your stocks. So in it will be a recap on page 18.
Got it.
And now we're going to go to Schedule E. Now, Schedule E, page 19. If I go too fast, stop me, okay? Because, okay. So,
Okay.
Schedule E breaks down into two things. One of the
Part two.
in the two parts. Part one is your real estate properties. Part two is your business income, which is reported under LLC or under LP or under Schedule incorporation or corporation. So let's stay with the page 19.
Okay.
Let's go back to page 19. Now, page 19, it will be very important for us to review. Those are your real estate income or losses. Now, when we look at the page 19, it's a little bit tricky to pick up the right income or expenses because it will recap how much money you made, so which is going to be on a line 3, rental received or royalty received. In here, it's also going to tell you what property it received for. So it's going to have ABC. It's going to tell you what kind of property it is and from how long it's been rented. So if you bought a property in the middle of the year, it will say 180 months rented or 240. So
And what line would that be on?
it's going to be on fair days, potential days. So it's going to be right on line 1B and A. So it says personal use or qualified. So here it's going to say line A will say property, one family house. How many days? 1A will say property type. Then you have another A. It's going to be how many days it was rented.
Okay.
Right? So then over here, you're going to have all the expense, so income and royalty will be on the line 3 and 4. And then all expenses below. Now, what do we do if it's a rental income? We're going to take a look is how much depreciation were subtracted. We're going to add back the depreciation.
Which is page 18.
18. However, we're going to deduct principal amount if there is any mortgage, which is on the line 12. On the line 12, only going to show the interest portion of the mortgage. So in order for us to know how much income or losses to pick up, we must have most current mortgage statement so we could determine how much was the principal, how much was the interest. So we're going to add back the principal portion as an expense.
Right. So this type of P&L statement also works for W employees and 1099 employees because W employees can have
rental income.
So on and so
Correct.
forth.
Correct. So if you have a client who has only W-2 income, we will not ask for tax returns. If they have property and they rent it, we will ask for tax returns because we're going to make sure that the person show the rental income on the tax return. If the rental income was not on the tax return, we cannot use that income unless
as qualified. Yes. Yeah.
As qualified income, unless the property were bought the same year and it was renovated and start renting. Then we would need all proof the rent income received during the current year. If the property existed for more than a year and it was not on tax return, most likely we will not use qualified income unless it has a very, very strong motivation factor why it was not rented in the prior year.
I have a question. How would you qualify then if you have somebody who has a 2-family house? How would you basically itemize the second apartment renting?
It's right here. It's going to be my so basically on the top of the tax return will have your current address, And then here it's going to say it's 2-family house rented for 360 days. And it's going to be show the income for the whole year of the second unit. And it's going to have all the deduction. Now, what we're going to do is we're going to take a look at how much mortgage they have.
Yes.
And because it's going to be deducted portion of the mortgage out of the tax return. So we're going to analyze it that way and still give you benefit of the rental income minus deductions, but we're going to remove the mortgage tax and insurance because it most likely will be on your current mortgage bill. If it's not, then we're going to portion of that put back as a less deduction because you already deducted on your tax.
I just wanted to give a concrete example, put it into context so everybody could understand what we're talking about and relate. Because it might be foreign to a lot of people, right?
Correct. So, but the thing is, a lot of times what people do is they put down huge amount of money deducted under repairs, supplies, utilities, and other expenses. If they're gonna write off everything as an expense, then we really don't have room to pick up additional income. So you gotta be careful with that. Okay. Next page. So on the page 20, it explains to you in a full details everything that what deduction means and if it's possible to deduct. It has all the details of the, so page 20 and 21 gives you full details of all the deductions are, are on your tax return and what it means and how much is deducted. So then you're going to go to page 22. So basically on page 22, it just gives you how much combined lines of 7 and 15 on the previous pages. And
and those lines were expenses.
Right. 7A. So basically, hold on a second.
Yes, ma'am.
Right. So basically, it's going to be your net loss or gain from a page 16, line 16 on a form 1040. So we're gonna go further.
So 1040 is just give a recap of the 1040 is basically it's the regular tax return, right?
Correct. And so then we're gonna go to the page 22. So page 22 gives you a recap of gain and losses in stocks, right?
No, page 22. I am at page 22. Yes,
23.
we were reading the line number 16. Yes.
Yeah. So now go down to page 23.
Okay.
It gives you that stock they bought for IBM. They bought it for 5,000. So basically, sales were 5,000. They bought it for 6,000. So they lost 1,000. Remember, on the Schedule E, it's not only your rental income, it's your rental income, your stocks, your businesses. So the stocks will be recapped over here. And then you're going to go down. Now we're going to go to supplement. I want to show you how the rental income works. So you could see on page 24, it's going to recap it to you the addresses of the property, what kind of property type. So if you're going to see line A, it was a one-family house. Line B was commercial. Line C was one-family house. And here it shows that on 1A, it was rented for 365 days. Line B was rented for 365 days. But line C, which is 321 Rodney Boulevard, only was rented for 90 days. So you have your rental income. So then you have all the expenses. As you could see on this example,
I'm going to go slow so at least I can see. Okay.
Yeah, so scroll a little bit higher.
Recap a little bit. So you have each address and on line A, B, C, and underneath there is an explanation of type of properties with numbers 1, 2, 3, 4 5, 6, 7, and 8, giving you anywhere from single family residence, multi-family residence, vacation home, commercial properties, land, self-rental, royalties, and other type of income properties, correct? Or the type of investment.
Okay.
Okay, I just want to make sure they see it. That's a lot.
Yes. Yeah, it's a very complicated, but it's still fun.
It's still fun for those who like tax returns.
Okay, so bring it up so we could see a rental receipt and all expenses. You can make it higher.
Down. You want me to go down on the page?
Down. Yep.
Okay.
Stop. Okay, perfect. A little bit higher.
Okay, meaning a little bit lower. Okay.
One more, because we want to see the rental. Okay, can you see the rental income?
I'm seeing all the income at positive amounts do not include any loan.
No. You got to go higher on the page.
I need to know which
rental receipt, line
which
3.
line what?
Line 3.
Ah, okay, so top of the page. All right, rent
Okay,
receipt.
good. So we're going to see rental income for all 3 properties, A, B, and C. Then you have all the expenses for the property. So bring it a little bit higher. Good.
Okay.
Perfect. Now you're going to see the first 2 properties, they had mortgages. But on the third property, there is no mortgage.
Would be line 12.
Line 12.
Mortgage, yes.
Correct. So now we would need to see a mortgage statement to find out how much is a principal payment or throughout the year. So when we're going to calculate it, when we pull the credit report, we're going to have those 2 mortgages on the credit report. So when we're going to calculate the net income for those 2 properties, we're going to take, you see that you have subtract, so you have a loss of $2,350.
Where is that?
It's on the line 21.
Okay.
Right? So the way we're going to do it, we're going to take a
for
loss
property number 1, you'll on line 21, there will be a loss of $2,350.
Okay, then we're going to add the mortgage. We're going to add which is the line 12.
Okay, yes. So
we're going to add line 16 because if it's
taxes, yes.
If it's in a mortgage statement, taxes and insurance paid through the mortgage, we're going to add line 12. We're going to add taxes. We're going to add the line 9 for insurance. And we're going to add line 18 for depreciation.
Okay, so
that's going to be our income. And then when we have a credit report, we're going to subtract the mortgage out of that income. So most likely we'll still have a bigger loss.
So that total income was those total expenses were $8,250, and we had that loss, and we still don't know what the mortgage is. So we have
correct, but that's how we calculate.
Okay.
But that's how we're going to calculate from our net loss. So let's just take a look for a seat because there is no mortgage there. We're going to say, okay, we rented only for 90 days. Our rental income was $4,000. Our expenses were $1,500. So our profit was $2,500. Okay. Now, to that, we got to figure out, well, it's only 90 days, but we are next year, we're going to get 360 days. So we're going to prorate to 360 days. So we're going to do 4,000, divide by 90, multiply by 360. And we're going to do for every line to find out exactly what our income will be. At the same time, we're going to find out how much is the taxes, because for 90 days, it's only said $90. For insurance, it's only said that $50. So when we do the tax...
Let's look at this. Oops, so sorry. Let's go back.
Okay. So when we do the rental income, even though we take a look at the $350 for 90 days, We ask for a copy of a tax bill and insurance bill to make sure that tax bill and insurance bill are still in line over previous year.
Let me go back. For some reason, I lost our thing. Let me reshare my screen. Thank you. I'm going to go back to the application window. All right. And we were on page 25?
Yep, 24.
24. It's not letting me. All right, so let me just go back down. I was typing it up and it's not grabbing it. We're almost there. I don't know how I lost that.
Perfect. Okay, one more up.
Yes.
Excellent. So when we look at the income, if it's not the whole 360 days, we're going to prorate it, figure out per day income and expenses, and then multiply to 360 days. But at the same time, we're going to match the taxes and insurance to make sure we are in line with most current year in order to find out if of a net income. So on every rental property, we do require copy of the mortgage statement, copy of a tax bill, and insurance bill. On a regular program, we do not require a copy of a lease unless it's a most current year.
What do you mean by regular program?
Conforming and a high balance mortgage. On jumbo mortgages, we do require to collect all the leases.
Okay.
But on a conforming and jumbo conforming, we do not require that copy of the leases. So let's go to page 25. Now, page 25 recaps not the rental income, but it recaps the businesses. On this particular one, it recaps partnership. Okay? So it has tangible, real.
Hello.
Hi. So on tangible, so basically it has three different income. You have two partnership income and one is a Schedule S income. Now,
Okay, so where do you see this?
So it's A, B, and C.
Okay. Okay, so we have P, and S. Okay.
P, P, and S. Now, if we see the income that shows here, we will request copy of K1s. K1 is basically anytime when you have a partnership, schedule, corporate, C corporation, incorporation, or S corporation, for the income, they will issue you K1s. Once a K1 is given, we look the percentage of ownership. If it's less than 25% of ownership, we will not require tax return. If it's 25% or more, we require to see business tax return. So by looking at this, you will not know whether the client is less or more than 25% shareholder.
Yeah.
You only will be able to see on K1. As we're going to go down further, I want to show you how K1 looks like. But in here, it shows that on, so basically you have line A, B, C, and D that will recap the businesses' names. Then you know which business made money or lost money. So let's take a look. On a line A, the business lost $5,800.
That's the non-passive income and loss.
Correct. And then they made $2,000. On line B, which is Westchester Development, they made $21,000. And on the line C, Creative Network Design, they made $4,000. So together in those B and C, they made $25,000. So they lost on a tangible realty $5,800. So and they made $2,000. So Here, the way it's going to show, it has positive 2,000 on line 8. Then on the bottom on line 30, it's going to add up the
27, yeah.
Correct. So, and then it has 27,000, which is 25 plus 2, and minus 5,800. So net gain is 21,200. Now, how are we going to be able to use all 21,200? And the answer is yes and no. In order for us to know if any of this income is usable, we have to take a look, how much percentage of the business a client owns. If they own more than 25%, we have to analyze the business tax return. And based on the business tax return, we're going to identify if any of the income is usable. How would we know? We're going to take a look at if the business distribution were given throughout the year. If the person did not take money out of the business, then we're going to analyze if a business were able to pay the client. If the answer is no, even though you show the income of 21,200, it might not be usable at all. So it gets very complicated on a self-employed income, how much income we can or cannot use. Okay, then we're going to go to the page 26. Page 26 and page gives you a very detailed explanation of all the incomes and all the options of the incomes on Schedule E. So you could read that at your leisure. Now, let's go to passive active loss limitation.
Page 27. There you go.
Page 27. So in here you could see so basically, remember, we had net income of 27,500, and we had a $1,100 loss on your IBM stocks. So then, so you have 27,500, and then report losses on income. So
that was the combined losses between the IBM and the other business losses.
Correct. Plus, you're going to have combined income. So then you're going to go down to page 28, and that's how K1 looks like.
All right.
So that's a fun one. On a K1, you're going to show whether the client has ordinary business income or loss. So remember, we had one tangible realty that showed loss of 5,800. So it's going to show 5,800 loss. It's going to show here the profit loss. Basically, they're 20% owner. So we're not going to request tax return, but we will take $5,800 as a loss. Okay. Then we're going to go to the next one.
So it shows on this J line that they are 20% partners only. Okay.
Correct. And we're not going to ask for a business tax return.
Okay.
Okay. So then we're going to go to the next K1. Remember, on Westchester Development, they made 21,000. Now remember, K1.
I'm on page 29, so that might not.
Go to page 30.
Thank you.
Now remember, each corporation or partnership or S corporation or incorporation will have its own K1. So, and that's why it will be recapped on the Schedule E. So remember, we had a Westchester Development LLC,
yes,
and it showed net income of 21,000, and it shows that they were 50% owner. So that means a business made $42,000. Our Genie borrower, they received 21,000 rental income. Now, on this particular rental income, it doesn't show the distribution were done. So what we're going to do is we will request a business tax return. If it's a real estate tax return, we're going to see we could add back depreciation, but we're also going to see any loans for that business, and if the business were able to pay $21,000. If the answer is no, because then that income will not be usable. Also, we're going to take a look at 2000. Let's assume this one is for 2019. We're going to take a look for 2018 income for both losses and profit. We're going to see we have the average. If the income for 2019 higher than 2018, we will average the income. If the income 19 is lower than 18, we will not average. We're going to take a lower income. We also will request for the accountant to do profit and loss statement from a last time the tax return was issued to most current months. We will double check to make sure the company still makes money. If most current profit and loss statement shows a big difference, then the income might not be able to be used. So the answer to usable income is going to be a lot more scrutinizing and analyzing to see if that rental income or if that business income could be used or not. So unfortunately, for self-employed individuals, income is a much more complicated. You're not going to be able to learn everything in one training, but that's what we have to do as a mortgage people. We have to analyze in order to see if the income is usable or not. So the last one, creative network design, it showed that ordinary income was 4,000, and this one is also shareholder of 50%. We again will show that we would need to review and analyze business tax return. And that concludes our how to read a tax return. Now, I know it's been very complicated and too much information. So if you have a tax return that you want me to analyze with you, please email to me with client authorization, and we will go over together.
Let's go over your phone number again. I'm going to just post it here.
Right.
So agents can contact you.
The best number for me to contact is my cell number is 917-854-4657. I could also be reached in my office number, but however, we all work, we no longer work at the office. We were supposed to be open December 31, but it was moved to March 31. And even that we don't know. But meanwhile, we all work remotely, so you could call me either numbers. You could reach me.
All right. I guess this is it, right?
If you have any questions, I'm open for any questions. And I know it's complicated.
I know. It's okay. I know. But I guess we got a good overview of what needs to be done. You have, it's a big task of looking at tax returns. But thank you again. Thank you for sharing with us. And let's see what we can discuss next time. All right?
Yeah. Well, guys, what would you like to learn? What would be interest to you and beneficiary for you?
Okay. We can think of it. And you guys can email, actually text Olga, or just shoot me a text as well, or an email. And I'll be glad to share that with Olga. And we'll find next 2 weeks, we'll have a good training, right?
Yes.
All right. That's good. All right, guys. Nice seeing all of you. And
we made it less than an hour. I'm very proud.
I know. All right. So next one will be, I guess, towards the end of the year, right? In 2 weeks. It's going to be on the 28th. And we'll pick a topic. Thank you so much. Thank you for watching. And we'll see you next time. Bye.
Thank you. Bye.